Hi, my name's Steve Headon from Morse Garrett. Welcome to the second of our three-part webinar series for VetSure. In the first webinar, we considered the question, should I stay or should I go? And considered whether now was a sensible time for practice owners to be selling, and also the considerations that should be made when considering the benefits of retaining practice ownership. This second webinar carries on and considers the scenario where the decision has been made to retain ownership and considers the options for practice succession and how that may look. Now, for those of you who have dipped straight in at the second webinar, just a brief introduction of myself. I won't dwell too long on this for those of you who have already endured this on the first webinar. My name's Steve Headon. I'm one of the equity partners at Morse Garrett. We're accountants and business advisors with a specialist veterinary team. Within the veterinary team, alongside myself, are a further 4 partners, and we're acting for somewhere in the region of 400 veterinary practices of all shapes and sizes across the UK. Working in support of the 5 of us are a dedicated team including 15 qualified accountants, and as well as focusing on compliance aspects such as annual accounts and tax returns, where we really believe we make the difference is through our proactive and consultancy advice concerning a whole range of issues practices face, from performance management to considering tax planning, and then also business structuring and succession planning, which is obviously where the lecture today focuses. So this lecture, at an overview, starts with the starting point of we're not selling, so what next? So in this, we'll go through the points that we need to consider at the start. We'll then go on to look at how internal succession planning may work and the changes we've seen in recent years. It's becoming clear with availability of funding that parity equity ownership is becoming increasingly challenging, so we'll look at how non-parity equity ownership works and the considerations that need to be made there. Joint ventures are also something that increasingly we're seeing independent practice consider, so we'll look at how they could work and how they may be of benefit to your practice. There are other things that we need to consider, and never retiring is one of those. Retaining the practice for the long term and keeping that investment and ongoing income stream is not something that traditionally has happened in veterinary practice, but is something that we believe we may see in the future. And then finally, we'll just touch on business structuring and restructuring aspects that need to be considered alongside all of these factors. So in overview, there are various key points that need to be considered at the outset when reflecting on how succession planning could work and making sure that it works for the practice and for all involved. So one of the primary concerns that we see, particularly of senior partners who are retiring or coming up to retiring over the coming years, is the risk of being shortchanged. So what can be done to protect them from receiving a lower payout under the partnership structure and then seeing the practice sold shortly afterwards. Similarly, incoming partners profiteering. Now, undoubtedly, an internal succession strategy will not work at current open market valuations for practices. So if that decision has been made, undoubtedly practice shares changing hands at an internal valuation basis is going to be the case. So making sure the incoming partners cannot profiteer in the short term will be a concern for outgoing partners, and something that protection would need to be put in place against. Funding is the other big consideration. What can we do to fund or help new partners fund their buy-in with restrictions on availability of finance, and also increases in practice valuations, and that leads us to a change in perhaps what's been carried out previously. So a move away from parity ownership is something we're seeing regularly within practice, and there's a fear that that then moves away from the partnership ethos. I don't believe personally that it needs to move away from the partnership ethos, but there is undoubtedly going to be a change in the way things are structured, the way in which profits are shared, etc., to make sure that that is appropriate under the new structures that are put in place. So dealing first with the primary concern, particularly for retiring partners, is that if the practice isn't sold and valuation basis continues on a more traditional partnership valuation basis, they're going to be left shortchanged, and the new partner is going to come in and profiteer at their expense. Dealing first with the valuation point, it's important to recognise that at current valuations, it's not appropriate for a sale of a share of the business to be undertaken on that same basis. Primary factors being that where a practice is sold, the continuing partners or the previous partners, I should say, will continue to have a working requirement in the practice. So invariably they're taking a reduction in income, for a substantial reduction in income, for a period of time whilst they continue to work. So valuations need to reflect that. Equally, for the acquirer buying the whole practice, they're always going to pay a premium as compared to buying a share of the practice, given that that allows them control and therefore to make decisions as they wish. Now, in terms of how you then deal with the gap there and preventing a retiring partner from being shortchanged, the most common and practical approach to that is to include provisions within the retirement agreements, be that a retirement deed for a partnership or a share sale agreement where shares are being sold in a practice trading through a limited company structure, which provides for an additional payment to be made over a period of time, which reflect should the practice be sold following their retirement. Now, those provisions are typically termed either windfall clauses or anti-embarrassment clauses. Sometimes they'll be called additional consideration clauses. They all do the same thing. It's just different names. Typically, they'll last for a 3 to 5 year period and make provision for where the practice is sold. Consideration is given to the difference in valuation on sale compared to retirement valuation, and then a proportion of that is paid across. Now, there is all sorts of level of detail which is outside the scope of this webinar as to the calculation on which those are based, but certainly that's something where we would be able to provide additional input where appropriate. I think the key position is that it needs to make sense for all, and certainly for a number of years we've been giving practices advice when it comes to property investment decisions, where undoubtedly where a new practice is developed, the cost of developing that practice is very often in excess of the market value of the property once the development is complete due to the veterinary specialist fit out. So we've been putting in place for a number of years ring fencing provisions to make sure that a retiring partner doesn't suffer a unfair proportion of that cost when they have very little time to benefit. Now, an anti-embarrassment clause is essentially a reverse of that, and that's putting in place a clause whereby a retiring partner, where they're receiving a reduced valuation, has an opportunity to receive an enhanced valuation if and only if the continuing owners of the practice decide to then sell for an increased value, ensuring then that the retired partner receives compensation that reflects that. So once we've resolved the issue in terms of protecting the position for retiring partners to avoid them being shortchanged, our attention then turns to structuring a new partner or shareholder. And throughout this webinar, as you've no doubt already noticed, I'll use the term partner to reflect both partner and also shareholder in a business. So how they would go about funding their buy-in. And I think it's fair to say that with valuations as they are, undoubtedly buying a parity stake in a practice is a far more expensive proposition than it has been historically. That doesn't necessarily mean it's no more lucrative and the returns are far reduced. It just simply reflects the changing face of the profession. We've got a return to up to £300,000 unsecured lending by banks, so certainly the restrictions on lending that we saw 6 to 10 years ago are starting to be relaxed, but nonetheless they're on a far more selective basis than they have been done historically. Certainly if we go back pre-credit crunch, when banks were almost falling over themselves to lend to vet practices and individuals buying into practice, that situation has changed somewhat, but funding is available and can be sought where proposals are sound. So looking at the new world where we are now, certainly people coming in at non-parity stakes, buying what they can afford, potentially buying up shares later in increments, and funding from profits is an option. We have seen scenarios which can work well where the existing partners in a practice match funds. So, for example, keeping the numbers simple, if an incoming partner could only borrow £100,000, then the existing partners may sell them £200,000 worth of shares and give a personal loan of £100,000. In that way, the existing partners may charge a premium rate of interest on the match funding so as to incentivise obtaining funding from external sources and also the repayment of that loan over a relatively short period of time out of the profits of the business so that it's affordable for the incoming individual. If we then once we've got the income as dealt with, we can then look at exits being funded by various mechanisms, but ultimately funded by the practice. So CPOOs is a company purchase of own shares, or a holding company can be put in place. Again, the detail of that is outside of the scope of this webinar, but what that allows is the practice to then pay out future retiring partners, and then the continuing shareholders see a proportionate increase in their shares, so those new partners can see their shareholding increase over time. So moving on to consider the arrangements for new partners funding their buy-in, and also parity ownership and partnership and the other options that are available. Where we're looking at non-parity arrangements, remuneration or profit sharing is one key consideration. Now, traditionally, veterinary partnerships have been parity, so therefore profits have been split equally. There may, in some instances, have been prior salaries where adjustments were made for part-time working and the like, but on the whole, practices have tried to stick with simplicity of everything being equal. Now, with a non-parity arrangement, that no longer works, and it therefore is a requirement to make it stack up for individuals who are buying into the practice, that there needs to be a commercial arrangement whereby everyone working within the business, including the shareholders, are remunerated by salary at a market value. Now, there may be tax planning options which can then be taken to pay that salary in a more tax efficient way than through the payroll, but ultimately there needs to be that first share of profits at very least to represent a salary, ultimately in much the way as the corporates or any other commercial business would do, value the people for the input they provide, and then ultimately the residual dividends are the return for business ownership or the return on investment that's being made for the shares that have been purchased. The downside of that is that tax efficiency does take a hit unless proactive steps are taken. Use of personal investment companies is one thing that a number of our clients have been putting in place to combat this, and that's where the shareholders with a higher shareholding are using vehicles such as that to divert some of their profits towards to allow the new shareholders with lower shareholding to extract the vast majority of their profits in order that they can service loans that have been taken to fund the borrowings. Again, outside the scope of today to go into the detail of that, but just to say that there are options, but ultimately we need to get the commerciality right first so that it stacks up. We can then look at the tax planning as a second step. A further option that can be considered as an alternative to non-parity ownership, or equally as part of a non-parity ownership buy-in, is the use of a group structure to allow new partners to buy into part of the business rather than all of the business. Now, we'll explore this further in the following slides, so I won't dwell on that too much here, but ultimately what can then be used in the future is, as the value of the subsidiary increases, it may then become appropriate for a share-for-share exchange or alternative mechanism to be used, such that the value that the individual has accrued within the subsidiary can be exchanged for a shareholding within the core practice over time or at a defined future date. Now, if we go on to consider group subsidiaries and in particular the use of a subsidiary to hold part of the existing practice to enable a member of staff to buy into that. Now, the mechanism there where a group structure is currently not in place would be to hive down, so transfer the trade of that specific section of the practice into a subsidiary. There's then a corresponding loan from the holding company to the subsidiary, and the shares themselves would have a notional value. And that may simply be £1 or £100. It would be a relatively small value. So the new partner can then buy into the subsidiary. They can introduce a director's loan to compensate for investment, or they can buy into the shares at a later date when they hold the majority of the value and that loan has been repaid. There's various mechanisms again that we can use to structure that, but it can be used to help manage the buy-in cost, because if the employee who's buying in does not come in fully funded, then hopefully ultimately there can be an imbalance of investment held by the holding company that can be repaid over a period of time. It's important when using a group structure that any cross charges are fully priced such that the profitability of the subsidiary is a fair reflection of the underlying performance, and that's perhaps one of the most challenging aspects to this. Obviously, where you've got shareholders in the whole practice, even if you have divisional reporting for management reporting purposes, the actual cross charges, whilst they need to be sensible, the accuracy is less of an issue because it doesn't determine what someone's earning. Now, ultimately, it's good business practice to have properly costed business components such that you can monitor performance, but that is an aspect to consider. With that structure in place and the new partner being employed and owning a share of the subsidiary, their remuneration is then based solely on that subsidiary profit. So obviously a key reason for getting it right, but also in terms of incentivization, it's that part of the business that that individual is then engaged in and can hopefully drive forward. Now, taking the idea of a subsidiary then a further step, instead of using an existing part of the business to be transferred into the subsidiary, a further option that can work very well, and certainly I know a number of practices are exploring this, is to essentially set up a new branch as a joint venture. So again, a subsidiary can be formed. Again, the funding can be provided from the main company. The value of the subsidiary, with the exclusion of that loan funding, is a nominal value at day one. So the new partner, when they buy in, would introduce any funding onto a director's loan account, and again that cash can in part be used to repay the holdings loan if that's initially put up all the costs of setting up the joint venture. Again, cross charges would be fully priced, new partner remuneration based on subsidiary profit, etc. And in the future, the new partner could use equity in the subsidiary to buy into holdings. Now, where this can work particularly well is where there is a situation where a practice feels that they've got enough partners for the business they're currently running, but they want to develop, and they've got keen, enthusiastic members of staff who are keen on ownership. Now, setting up a new branch or division of the practice as a joint venture ultimately allows the individual who wants to buy in to prove themselves. It allows them to generate some value through their own work, but it allows the existing practice owners to expand the business without diluting the ownership of the existing core business, until such time as the new branch is generating sufficient profits that can then be incorporated at a top level, such that the individual exchanges their shareholding in that subsidiary to buy into holdings. But at that stage, it shouldn't dilute the profitability, because the profitability of the branch will be sustaining that individual in their own right, and ultimately the valuations would be based on a relative basis. So therefore, the profitability of the subsidiary would influence the valuation of the subsidiary. Obviously, the group on a relative basis there would mean that the overall equity or profit, if you like, of the original owners was not reduced in any way unless additional cash at that stage was introduced by the new partner, such that they could increase their equity stake potentially to parity. But obviously the existing partners would have had the benefit of any profit generated by the new branch, or certainly to the extent of their shareholding within that. Now, we touched earlier on the option that practice owners never have to fully exit. Obviously, the traditional route is that on retirement or on a sale, cash is released, but then ultimately that cash needs to be invested to generate a return. Equities in listed companies are often the route which is taken regularly under the guidance of a financial advisor, but in that instance, you find that practice owners are exchanging an investment that they understand fully for an investment that they don't particularly understand. And also with market volatility, with charges, they may only see a return of 3 to 5%, whereas the return from a practice investment may be 8 to 15%, depending on the EBITDA multiple that can be realized at that point in time. So whilst a substantial cash lump sum can be released, as we've shown in the example in the first webinar, the returns would be reduced. So potentially retaining controlling ownership and selling perhaps small equity percentages to key staff members, or promoting senior staff to a profit share arrangement is not without risk, but that could be an option for some practice owners to retain an income into retirement in a business that they know, in a business that they may choose to and wish to retain an involvement in, albeit on a reduced scale, and that allows you to engage senior members of staff by having them owning a proportion of the business, or as we say, if that's not appropriate, benefiting from a profit share, such that they're incentivized to grow the business and help that develop. Now, clearly there is an eggs in one basket sentiment to that. It wouldn't be appropriate for all, and particularly as an individual grows older, the risk profile there may not be appropriate. But certainly, even if never fully exiting isn't an option, potentially phasing out over a period of time or reducing input while still benefiting from the profits realized from the business, certainly in the latter part of a working career and the early stages of retirement, could be appropriate in some instances, and certainly we have seen that work well for some. Now, a further option is a joint venture with like-minded independent practices. So what we're talking about here, and we have seen work in practice, is an existing independent practice that has a partner exiting. Now, in that instance, the say it's a two-partner practice for the purposes of illustration. One partner wishes to retire and the other partner hasn't identified any members of staff to buy in, and equally is not keen on the prospect of borrowing money or becoming a sole owner. So in that instance, another typically local practice could buy into the practice, buying up the exiting partner's stake, potentially on an earn-out basis or on a cash upfront basis, on an existing partnership valuation. Practice 2 can then provide support, it can provide management input, potentially buying power, critical mass, out of hours dilution, again all depending on the practice profile. But in that instance, all parties benefit, because practice 1, and more importantly the partner remaining in practice 1, get to remain independent, get to see the benefit of the ongoing profits and development of the practice, whilst practice 2 gets to expand their critical mass and develop their business. And then ultimately, depending on how that works in the future, in the same way as we've shown with the other joint ventures, it may be that there is a full merger of the practices and the partner within practice 1 becomes a shareholder in the group. It may be that practice 2 ultimately buys out practice 1 in the fullness of time, but either way that allows for a staged transition, which in most cases corporate ownership does not. Obviously, there are some examples of joint ventures, but that's not something that all of the corporates readily offer. Again, as with all options, there is a risk element to consider, but that is something that certainly is worthy of consideration, particularly where you've got a smaller practice, typically maybe 2 to 3 partners, where there's a wide age profile, so a full sale route isn't appropriate, and traditional succession for whatever reason isn't considered to be feasible in that practice's circumstances. So before we look at some examples to try and illustrate the options that we've covered in the previous slides, the final point just to touch on is business structuring and restructuring. We've mentioned in the previous slides potential use of group structures, non-parity ownership, remuneration, so share structures come into consideration there. Ultimately, the business structure has to reflect the commercial arrangements and will be bespoke to each arrangement. There is no one-size-fits-all approach because no two practices are identical. Tax considerations are important, but they must play second fiddle to the overall commercial requirements of the business. If you try and tear yourself up in knots through tax planning, that risks just unraveling down the line. That said, once the commercial structure has been sorted, certainly tax considerations are important at that stage, because the key to any practice owner is maximising what they're left with after tax. So if anything can be done to legitimately and sensibly mitigate the tax burden the practice faces, then those considerations need to be taken. Forward planning is fundamentally important. It is far easier to plan a business structure on a medium-term planning horizon rather than leaving things until the last minute, and therefore in this instance, as with all succession planning considerations, the earlier discussions can be had makes for far sounder and better planning in the longer term. So now turning to look at some examples, we're taking the example here of an incoming partner buying into a branch or a species work type, so a part of the business, so using a subsidiary to split out that aspect to then allow them a reduced buy-in cost, potential gradual funding build up over a period of time. As we've touched on earlier, that could then be used in the fullness of time to exchange into a share for the whole. Now, buying into a subsidiary isn't without its complications, so therefore certainly it isn't something that would work for all practices, but it can allow for a more targeted, focused succession strategy that allows the use of people buying in to target the development of particular aspects of the practice, perhaps those which don't have a partner influence, or where it's felt and require more senior input to fully develop them. So looking at an example of how this would work in practice, if we take the situation, we've got a small animal equine practice of which the overall value is 2.35 million, the equine element being valued at 850,000, small animal at 1.5 million. So if we've got an individual buying in, starting point would be a potential 25% ownership of the whole practice, which is going to lead to a buying cost of just under £590,000, which clearly, without existing assets through which to secure funding, is likely to be out of reach for a typical new partner looking to buy in. So if we then consider a restructure and how that may work, ultimately the holding company would have that existing value of 2.35 million, but we could set up two subsidiaries which own small animal and equine. Now, rather than the shares being valued at that amount on day one, the shares would have a nominal share value, and the value of the businesses would be owed to small animal and equine. So then if, say, an individual were to buy into small animal, the amount that they would need to put in to acquire a 25% stake of the business would be 25% of that nominal value, say £100 in this illustration. So all they would need to put in is £25. Similarly, if someone buying into equine, a 20% holding would be £20. Now, in practical terms, the value of the business would be owed to holdings, that would be owed by small animal equine divisions, so there would need to be a payment schedule set up, interest would need to be charged, and certainly you would be unlikely to allow someone to buy in for such a nominal sum, but you may allow them to buy in for a much reduced sum from what they could afford, knowing that there was going to be compensation through interest for any differential in investments. Now, again, there's a huge number of factors to consider here. It's also worth noting that, again, I won't go into the detail, but there are tax considerations as to how big a percentage can be sold without potentially adverse tax consequences in the initial period. So that would need to be considered in detail as well. Ultimately, what we're doing here is setting up a structure whereby the existing value of the business is locked in for the existing practice owners under whatever valuation method they choose is appropriate for them, and the new partners own their percentage of any growth in value from the point of transfer or the point of buy-in. So that's what this structure allows. It allows that benefit of the accretion in value in the future. As I say, there are a number of considerations that need to be taken into account, but broad principles for today just set out how a group structure could potentially be used. Now, considering the previous example, there is certainly an element of altruism in allowing an individual to buy in on an underfunded basis. It's appropriate in some circumstances, it's certainly not appropriate in all, and it does depend on the existing practice owner's outlooks as well as the needs of the business. But the alternative, as we've touched on earlier on in this webinar, is to consider a minority share, where you simply consider how much the income can raise in funding, and then you simply allow a share purchase based on that level of funding. And we go on to the next slide to consider how that may look. So again, if we take the same example as in the previous slide, we've got a business here that's worth 2.35 million, and we've got an individual that's got £200,000 worth of funds available. Now, in that instance, they could acquire 8.5% of the whole of the practice. But for example, they may be a small animal vet and they may have no interest in the equine side of the business. Now, again, for a mixed practice, it's a step that needs to be considered in quite a lot of detail before you have too many people buying into one or other sides of the practice, because that can create division over time. But as an initial step towards practice ownership, having the individual buy into the side of the business in which they have the greatest interest and can have the greatest impact can be beneficial. Now, again, considering that £200,000 worth of funds available, were they to just buy into a small animal subsidiary, they could buy a 13.33% stake. So that may be appealing for the individual, as they can buy a greater share of the business through which they have greater influence. Also, for the continuing partners, they may feel that that is most beneficial to the practice at the early stage, whilst the individual is developing their own management skills and getting to a stage where they can deliver benefits for the whole practice, them retaining the equine side of the business, or potentially introducing an equine shareholder on that side of the business as an initial step. That could work well for the practice. Now that wraps up the slides for this webinar. Now, hopefully the slides that we've covered today do allow a flavour of the options that may be available. I can't stress enough that if practice owners are considering restructuring their business or changing their succession strategy, then doing that has to be done with professional advice. Now, ourselves at Morse Carrot would be more than happy to provide input, quite happy to answer any queries on the content of this webinar itself, and my email address is shown on the slide there. Certainly more than happy to discuss specific practice scenarios in more detail and provide input where necessary. So please feel free to get in touch, and thank you for listening.
Thanks again, Steve. We hope you enjoyed this webinar. The next in the series should be out imminently. If you want any information about how VetSure can help you in your practice, then please contact us by telephone or email, or visit the link on this slide to identify the veterinary relationship manager in your area, and we can arrange a meeting.